Now let's look at this rally, and we'll focus on small caps because that has been the sort of the major pain point. Is there a twist, or is this like a beginning of something, or should are we reading too much into that? So let's look at, let's say, small cap 100 index. We are somewhere near where we were beginning of 2024, so about a year's gain have been lost. But there is hardly any net loss per se from last year. There is good support here. Small caps have also rallied 6% since the very recent bottom. And the question is whether this can be termed as start to a proper recovery, or are we just sort of doing what we have been doing. So firstly, we need to break this trend of lower highs and lower lows. We are currently trying to make a higher high. If we do go there on some indices, we have gone there, but on the small caps we are yet to do that. So immediate resistance will come here. Once we do go beyond here, then we will look at whether we are making higher lows and going higher. So there is some chance other sectors are leading it, but small caps have not yet shown that kind of a promise. So how this is going to play in your head? For instance, somebody has let's say sold here. Now he or she is thinking whether I should buy now, whether I should wait now, how to take those decisions. So whenever you will find that you have no plan of action to the market, all this confusion will be there in your mind. And each drop people will get out of the market, and on each rise rally people will try to get into the market, and can get cut both ways on that. If we see the last let's say 2 years, you can see from April 23 till September 24, we had a huge run, like 127% on small cap index. So once we had that run, everybody started to take that for granted that this journey can continue on till infinity. But within 5 months, we've now had a drop of, let's say, 22%, and we really started to question small caps, the markets, whether market people should be there in the market or not. I mean, just look at the context where you have come from and where we are. After rising 127%, a drop of 22% is like, for me, that's like very normal. I mean, why would anybody sort of be really worried about this? So this question whether this is normal or not, to my mind, is not even a question. It's certainly a very, very normal sort of a scenario, but a different perspective can be built, where we can see the year-wise returns versus intraday drawdowns since the last 20 years to see the impact. So for each year, now what we will do is we will look at what are the net returns of that year and what is the max drawdown within that year, even if it is intra year. So this is the data of the last 2 decades. We've had some phenomenal years where we made 102% return, 52% return in 2014, 54 in 2017, 57% in 2021, 54% in 2023. So many years where 40 to 50% gain was made within 1 year. Of course, each of those years was also came hand in hand with big drawdowns. So if you let's see all 50% plus years, if that year or the year next you had a nice drawdown, so maybe this 2005 we had a 59% return, maximum drawdown that year was 15%, but next year it was 34%. Then you had a great year here in 2007, but next year we had a 76% drawdown. Then you had a 102% return here. Next 2 years we had a 23 and 19% drawdown, and then a third year was 35% down also. Then you had 52% return in 2014, and then you had for the next 3 years there was hardly any return, but a lot of drawdown in each year. Then you had a 54% return in 2017, and then two down years, or rather 3 down years, three drawdowns from there onwards. 40%, 23%, and 47%. Before you had a great another total returns here of 57%. Then the year next to that we had a 33% down year. Then we had a 54% up year again in 2023. You had mild drawdowns for these 2 years, and then now we are having a 23% drawdown. So if you were to see this entire landscape of last 20 years, nothing has gone wrong. I mean, we had an average 20.6% average returns, and the average intra-year drawdown has been 25%, and we are currently at 22, 23%. So we are not even at the average. and we've had years of 47, 33, 40, 35, 35, 76. So we've had so many much more worse years than what we are seeing, at least right now. Maybe we will go there, I don't know. But as of now, to say that the market has has done some great injustice to investors, I don't see that happening. Yes, I mean, we've lost ground from where we were beginning of the year or mid of the year. But then, every year cannot be a 50% year. And that's what, despite every year not being that, you're still, the long term average is at 20.6%, which is a phenomenal return if one were to be able to get in the long term, right? Anything above 15%, in my view, is a phenomenal return. But then, if you're wanting to get superior returns from small caps, then the extreme drawdowns that are there, 40, 50, 60, 70%, have to be absorbed in your, not just in your portfolio but in your psychology, that I am taking on higher risks because I want to get higher returns, and hence I am having to bear with this higher volatility. I can't wish it away. The only way you can wish it away in your overall portfolio probably is to have asset allocation. You build a portfolio where you are allocating to small caps, but you're also allocating to other assets which are uncorrelated to small caps, right? Negatively correlated. Maybe some bonds, maybe some gold, maybe some real estate, maybe some other parts of the market which are not so correlated with small cap returns. So that's how you sort of create an overall portfolio of a slightly better risk return profile. So in my view, this is absolutely normal territory, not unusual at all. We've had 50% plus returns in lumpy manners. I have no doubt that there will come a year very soon where we will have a 50% plus year again. Every 2 to 4 years, we are seeing a strong returns year. Every phase of that high growth year is also followed by sharp intraday down years, and that high momentum phases cool off before the next big move that keeps happening. So 20% intra-year falls have been followed by good phases. In the next couple of years, we've had this fall. The fluff is gone. The over ownership is gone. The blind following of greedy influencers is gone. So we are now in a more I would say mature phase where only mature money is there in the market, and historically such corrections are good, and they make a case for staying invested. Of course, the runway of the India economy is the sort of underlying theme that we all depend upon, that we will continue to have growth for the next many decades. So volatility isn't the risk, it is the toll that you pay on the road to long term wealth. So embrace the volatility, try to reduce it if you are not able to handle it by the methods that I just mentioned. And for those daredevils who say volatility is fine, whatever it is there, then you should allocate completely to the small cap space. Have strategies where you will be able to at least go from the current winners to the next set of winners, so that you're not stuck with the prior periods losers. That is one thing that you really need to do, and for that there are several vehicles that are available to you. So this is all I have for today's daily bite. Let me know how you survived the 2018 to 20 small cap, if you remember, because that was a monstrous small cap fall. We are nothing in front of that right now, the current fall. And if you survived that 2018 to 2020 small cap, you should be breezing through this one. Share us your experience on the comments, and thank you for watching, and do like and share these videos. Do subscribe to the channel as well. Thanks. Bye.